Hi, this is Stuart Weems, and welcome to the Investopoly podcast. My goal is to share easy to understand, evidence based, holistic insights to help you master the game of building wealth. Okay, so the first one is from Matt, and it's about asset protection. So Matt writes, I'm in two minds about asset protection and tax planning. Should I take the CGT hit now and move my circa $1 million of assets that are outside of super into a family trust for long-term asset protection, knowing that there's about a $500,000 capital gain that will be crystallized? Or should I leave them as is and start buying new assets in a family trust, knowing this approach won't protect my current assets and comes along with fees? I'm 41 years old, a single dad with a beautiful girl. That's my entire world. Very high income earner, $220,000 base plus $200,000 in stocks, so about $420,000 taxable income. I max out my super, have my home and an investment property. I invest roughly $15,000 per month outside of super into the share market. Tax minimization is a high priority, and I'll be borrowing from my equity in my home to invest in ETFs. I'm also looking at another investment property, but not sure if I should own it in a trust. I probably should put it in my personal name so that I can enjoy the negative gearing. I'm pretty sure the answer is keep the existing assets as is to avoid the capital gains tax hit and let them grow and set up a family trust now, then eventually a bucket company when we slowly buy everything through those entities. But would love your opinion. So I really like this question because it has an asset protection angle, and it's really interesting that there's a bunch of advisors, lawyers, and so forth out there that I think overestimate asset protection risks for the sake of a business model. Now, I know that's really skeptical of me to say that, and of course, I'm not suggesting everyone's in that cohort, but I've seen, over the years, some unnecessary complex structures on the basis of asset protection. And, we've got to be realistic, I think, about our asset protection risks because really over the last 20 plus years of really meeting and speaking to literally thousands of investors, I've never seen one investor get tripped up by an asset protection risk. That is, they've been sued for something that isn't covered by insurance or isn't covered by a structure. Now, that's just my experience, so it's not a big data set. But I think what we need to explore is what are the asset protection risks. Now, Matt doesn't tell me about his occupation, sort of suggests that he's PAYG. So if you're self-employed, there's three things that you can be held personally liable for. Any employee entitlements and associated taxes and super. More and more they're holding directors and rightly so, potentially personally liable for those liabilities. Trading while insolvent, directors can be held personally liable for that. And potential criminal occupational health and safety breaches. So look, if you're self-employed and you're exposed to some of those risks, yeah, okay, you might have some asset protection issues to deal with. But if you're PAYG, what are you going to get successfully sued by or how? Well, I guess if you own investment property, someone could have an accident in your property, you get sued. Well, of course, you should have in place landlord insurance, which will have public liability element there. So, you should be fine there. I've seen articles about situations where the landlord hasn't maintained their pool fence, for example, and unfortunately a baby drowned. There was an incident in Melbourne many years ago around this. If you've got an investment property in Queensland and it's a house, chances are 50-50 probably it's going to have a pool. So in some situations you need to have it, but I think as landlords we need to consider the risks associated with that sort of thing. So what are the asset protection risks? I don't think there's huge asset protection risks. And in the situation where there is, okay, yeah, we need to do some planning, but if there's not, let's not invent them, because protecting your assets could come at a cost and often does of tax inefficiency. And, I guess we know tax is certain. We're going to pay that next year. Asset protection risks are greatly uncertain. And if the risk is really low, I don't think you should go to great cost to minimize it even further. So in Matt's situation, if I've understood his question correctly, what he's doing is he's gearing into the share market at $15,000 a month. Just be careful with that, Matt. That's pretty aggressive, I would say. I know you're relatively young, but it really depends on, you're investing a considerable amount of money each year. I would want to make sure, if I was in your shoes, that that's invested in a way that's not, because you're investing in markets when they're at all-time highs. That's relatively risky because, what's the upside? I mean, versus the downside. I just want to make sure that that's being invested wisely. Putting that aside, essentially we're investing $15,000 a month funded by debt. So we don't really have an asset, not until obviously the share portfolio continues to grow over time, of course. But if I'm putting in 15,000 and my investment was 15,000, I don't have an asset protection risk. Matt, if you are a high income earner, then any additional income that you have will attract obviously a 47% tax rate. If you go and invest in a family trust, my question to you is, who are you going to distribute to? Well, you can distribute to your daughter who's a minor. She can get $417 a year. It's not a big tax planning opportunity. But do you have perhaps, for example, self-funded retiree parents, that you could distribute to? So that would be the question. If I'm going to do it in a trust, where am I going to put the income? Also, if I'm doing it in a trust, realize that any negative gearing associated with borrowing to invest is going to be trapped inside the trust. And because you're funding your contributions 100% by debt. And then the risk is, if the trust doesn't record a profit, even $1 profit, it will lose any imputation credits. So any tax credits that you get that year completely disappear. So when we're investing inside a trust, we really don't want that trust to record a taxable loss. We want at least $1 of taxable income so that we don't lose the imputation credits. So I think what I would do in your situation, Matt, is I would invest in a company. I would on-lend the money into the company. So, you're borrowing personally and then on-lending at exactly the same terms. So essentially moving that interest deduction into the company. And then I would invest there and I'd have the shares owned by a family trust. So at least you can quarantine all the capital gains, all the income in the company, get a credit for any tax you ever pay. And then one day, if you want to take money out of that company, it can pay a dividend into the family trust and then you can distribute it. And maybe, down the track when your daughter's over 18, you can distribute some of those dividends to her more tax effectively. But this is not advice, of course. Nothing in this podcast is advice. It's really just information. And so I don't know the ins and outs of your situation, but what I like to do with these questions is just unwrap it a little bit so that people listening can maybe learn a little bit as well, and some of the things that I would be thinking about in your situation. What I probably would do, just finally, I would probably say, you haven't told me whether you've got a home loan, Matt. And if you do, I imagine that's where most of your cash flow is going. But I would probably minimize the gearing rate, the loan to value ratio, if you like. So, for example, maybe what I would do is say, let's invest 15 grand a month, but let's fund it 5,000 from cash. And you might do that through selling stock, and so forth. And $10,000 of borrowing. So we're kind of gearing at 2/3. And that way, I'm going to at least hopefully record a profit in that company and be a little bit more tax effective by at least getting the benefit of the interest deduction, albeit at a 30% rate in a company, but at least all the capital gains and income, can be quarantined in that company. And that would be on the basis that you don't have anyone else other than your daughter to distribute to. So I've made an assumption there. Okay, next question is from Kyle. I'll just summarize. Kyle's got 2 investment properties, a house in Perth and a unit in New South Wales. The house in Perth is an older style property bought late 24 for $353,000. The unit in New South Wales was built in 2020 and purchased at that particular time. And there's a little bit of equity in that one. It's an 84% loan to value ratio. Kyle has a spouse-to-be, a partner. They plan to get married and have children in the next 3 years. Kyle earns $90,000. His spouse earns $100,000. And the spouse has a investment property that's currently being constructed, and similarly will have a bit of equity in it by the time it settles. And the question really is, knowing that, they'll have less disposable income when they start a family, Kyle's asking, should he sell the unit given that it hasn't really grown, kind of just grown in line with inflation, and then either buy a home because they don't have a primary place of residence, they're all investment properties, or buy another investment property. And Kyle mentions that the unit's only really grown in line with inflation. But Kyle, the property, you purchased that unit in 2022, it was built in 2020. There's not really enough time to really draw a conclusion. It's such a short period of time to draw a conclusion that it's not a good investment or that the growth rate has been poor. It's been a pretty patchy market over that period of time. It's such a short period that even if it had demonstrated fantastic growth, equally that doesn't necessarily give you a lot of confidence of what the future growth will be as well. It's just such a short period of time. But from what you've told me, it's a new build built in 2020. I mean, new builds tend to have a very low land value. You've probably paid most of the money in relation to the actual improvements of the building. And therefore, those properties just tend not to have the attributes to be able to drive long-term capital growth. So purely just based on that, which is not enough information, by the way, but would tell me that, yeah, okay, you've got to form a view on what the future returns will be, and you'd have to form the view that the future returns aren't going to be great. Versus the 3-bed, 1-bath house that you've bought in WA was built in the 70s. You probably paid mostly land value for that. Although looking at the purchase price, I'm wondering, where that is located. Maybe it's too far on the fringes of Perth to really drive substantial growth, but it's probably got more prospects than the unit. The other thing too that brings up a really important point is about building wealth and then also starting a young family. There's really two windows of opportunity, as I see it here, as both from personal and professional experience, is that the few years, in fact, just now for Kyle, before they plan to start a family, which is 3+ years' time, or if they don't, whatever decisions they don't make, so if they decide not to make any further investments over the next 3 years, then they probably won't be able to make investments, won't be necessarily in the right position to make investments for maybe another 5 to 6 years. Really, typically, I find not until the kids get to school age means that sort of expenses normalize. You get rid of childcare if you've got that expense, which is really costly. If you don't have childcare, then maybe one spouse isn't working. So either way, you hit from a cash flow perspective. And so the window of opportunity to build wealth is, before you have kids, and then, a little bit later when the kids are at school age. So it is a bit of a window of opportunity for then, how many times can I say window of opportunity? Anyway, there is an opportunity here for Kyle and his spouse to start really thinking carefully about what they do and what moves that they make. Whether you buy a home or another investment property. So I think it's probably sell the 1-bed unit, but whether you buy a home or investment property is partly a lifestyle decision, I guess. But also it's really about budget and locality. So if you can buy a investment grade property or as close to it and occupy it as your home, then that's probably the best way to go. If you want to live in an area that isn't necessarily going to make a great investment, then I'd say buy an investment property. But it is important. And the other thing then, it is important, to make those decisions because you do have that little window now before you start a family. And the other thing too you got to think about though is to make sure that you're going to be able to build buffers in place to get you through that period of time, where both people aren't necessarily working full time, you've got higher expenses, all those sorts of things. So don't overgear and don't put yourself in a really difficult position because you might regret it in 3 years' time and then have to unwind some of those investments. And there's obviously no point in doing that. You're not going to make any money doing that. So be careful, but also at the same time, realize that if you don't do it now, you might not have the opportunity to do it for another, well, not until really 8 years' time, perhaps. Okay, next question is from Michael. I'm going to just paraphrase the question. So Michael writes in to say that, in fact, I must have met him or had a meeting with him at some point, and they were tossing up whether to stay in Sydney or move back to New Zealand. I said to them, let's not do a financial plan at this stage until that's really clear. And just as a bit of a sidebar, that is always an important aspect to think about. Like, I find that if we have a level of uncertainty, and in this case, it's, where are we going to live permanently? I mean, These people, Michael, could have been originally from New Zealand, for instance, but they've got family both in Australia and New Zealand. I find just waiting a couple of years tends to reveal the long-term intention. So if there is uncertainty in your life around those sorts of things, quite often the best thing is just wait a couple of years and, it'll reveal itself eventually over that point in time. Now, they have finally made a decision. They're going to permanently move back to New Zealand. Michael bought a property in Auckland, great property for $2.5 million. Needs a reno, but it's in a fantastic location, a fantastic street. So well done there, Michael. That's fantastic. Unfortunately, they've suffered a significant bereavement of a family member here in Sydney. Now they've got to stay for another couple of years more than what they thought. And they estimate they can save about $300,000 over the next 2 to 3 years just from bonuses and so forth. They're higher income earners. And so what Michael's question is what do we do with that money? Because we don't really have a long time horizon. The goal is to renovate. The renovation is going to cost about $650. So the more that they can save over the next couple of years, the better off they will be. And they've got 3 relatively young kids, all in private schools. And quite rightly, Michael observes that they don't really have the time horizon to invest in property in Australia, particularly if they've got to sell it. And if they become non-tax residents, that causes a lot of problems with property in terms of not getting the 50% capital gains tax discount. So, Michael, the best savings mechanism for you from an after-tax basis is parking your savings, I think, in an offset account or in the actual loan in that property in New Zealand. I imagine the New Zealand property is probably being rented out, given that, you're still going to be in Sydney for the next couple of years. And so by repaying that loan, of course, you're going to minimize your tax deductions, reduce your tax deductible interest. But really, it's the best rate you're going to get pre-tax that's going to be at call. And I know it might feel like to you, given your age and stage of life, that, that's not exposing you to enough risk. But if your goal is to, save as much as possible so that you can contribute towards the renovations, you just don't have a long enough time horizon to either invest in the share market, invest in the property market, or really any other reasonable investment. The only alternative you would have is to invest in fixed interest or bonds or hybrid securities, something along those lines. But the return that you're going to get from that will be around about the mortgage interest rate anyway. So, you're better off doing that. So normally parking money in offset or into, repaying a non-tax deductible debt, a home loan, really is one of the best savings mechanisms or savings accounts, if you like, that are available to most people. So that's what I do in your situation, Michael. For the next couple of years, just plow as much of that cash flow into the loan as possible. Make sure you've got redraws. You can always draw it out again, and that'll minimize the amount that you need to borrow to do the renovations. Okay, next question is from Lisa. Lisa writes, I'm a new listener in need of advice. Thank you so much for your podcast. I find it really interesting and have learned so much already. So thanks, Lisa, and welcome to the podcast. I hope you continue to enjoy it. So Lisa writes, I'm 32 and my husband's 34. We have 2 young kids, 2 and 4. We first purchased our residential home in Albion Park in New South Wales in 2020 for $540,000. It's now worth about $800,000. With about $460,000 of debt. Thank you very much, property market. That's done pretty well for you. My husband earns $130 a year, and I'm estimating I'm going to earn about $40,000 a year. As I've only recently returned to work, we had a pre-approval for a loan of only $208,000. We recently refinanced our home loan and also got a separate loan for $64,000, which we're going to use as a deposit for an investment property. Obviously, it's hard to find anything in the market for $260,000, being the 208 plus the 64, and where the rent would cover the associated costs. My question is, should we wait until next financial year to see if we could borrow more, given it being my first year in business? I'm very torn as I don't want to miss out on the current equity in our home if this was to go down. And if we do wait, will it affect our borrowing capacity for future loan applications? So, Lisa, it's a good question. Building wealth is a marathon, not a sprint. It's a bit of a journey, and you would be wrong to rush it. So, you're not going to be able to buy anything for $260,000. I would almost say anywhere in Australia that's going to be a good investment. And if you have just started a business, you definitely, your borrowing capacity will definitely change over the next period of time, either negatively or positive, I should say, but depending on how that business is going. So if you're able to really grow that business and grow your income, which I reckon, because you're really young, should be your focus, then, that's probably the best focus today if I was in your shoes, rather than going and buying an investment property. Because if you can grow your income, your family's income, obviously through your business, not only does that generate more cash flow, more ability to be able to fund and hold a investment property, it'll obviously have some significant impact on your cash flow as well. Now, will your equity disappear, next year? Well, I mean, it's possible. Property markets don't always move in one direction. But the thing is, markets tend to move sideways and then through a flat cycle and a growth cycle. So, I don't know your property. I don't know that area really well, of course. But the chances of getting a valuation of 700,000 against your home in a year's time, I mean, if that was to occur, we're in probably a pretty ordinary situation as a general rule. So I wouldn't worry so much that your equity is going to evaporate. I would really just focus on building your family income, which is really to say building your borrowing capacity so that you're able to buy something that's going to be of a higher quality. And remember, it's not always possible to buy a property that's going to pay for itself, so that where the rental income is going to cover all the expenses. And I've recorded a podcast in regards to this, in fact. Okay, I just found it. I wasn't using episode numbers back then, but I published an episode, What Does a Rental Yield Tell You About a Property? And I published that on the 29th of November 2023. It's a couple of years ago now. I would say go back and have a listen to that podcast to understand, rental yields versus growth. And the other thing I would say, Lisa, is that sometimes investors, and particularly property investors or people that are interested in property, can be too focused on one particular strategy, and they end up just making their circumstances fit what they think is the best approach. So what I'm saying here is, if you're in a situation, either you or anyone else listening to this podcast is in a situation where they just don't have the borrowing capacity to be able to buy a good quality investment property, then borrowing to invest in property probably isn't the right strategy for you. Maybe borrowing to invest in shares is a better approach, because it's all about the quality of the asset and the leverage, right? So if you're going to borrow 200,000 or whatever it is and put it into an investment, the other side of the coin in terms of whether that's going to work out is, what return will you get? Well, you're better off if you're going to compromise on the quality of the property to be able to invest in the share market, because you can do that at any scale without compromising quality. And I've spoken a lot about diversified ETFs and those sorts of things that give you broad-based exposure. In the long run is going to generate good, healthy returns and will, suit a gearing strategy. So, quite often we think, oh, property, how do we make property work? And I'm not anti-property, I'm quite, in fact, pro-property. I'm pro-property and pro-shares, of course, but don't try and fit a square peg in a round hole is, I guess, what I'm trying to say. But thanks, Lisa. That was a good question. And as I said, welcome to the podcast. Okay, next question is from Ryan. Ryan writes, I'm looking at changing my current super investments with the industry fund pre-mixed option and was wondering what the tax implications would be. That is, I'm currently in Host Plus Index Balance and realize this is probably too conservative for my stage of life in mid-30s. If I change to Index Growth option, what happens with the realized capital gains tax in my current investment units on the transfer? So Ryan, all industry funds and many other super funds are what are called pooled funds or pooled super products, which means they're unitized. They strike a daily unit price, and imputed in that daily unit price is a provision for unrealized capital gains tax. And I've spoken about, the benefits of, or the difference, I guess, between a wrap platform or a self-managed super fund and a pooled super product, where in a wrap and self-managed super fund environment, you only crystallize the tax liability if you sell an investment, whereas in a pooled super product, it's always taken out. So the answer to your question is, your balance won't change. The tax has already been provided for. There's no downside to switching investment options at any stage. You were right that if you're in your mid-30s, you should be, to my mind, if you're comfortable with volatility, and really, if you're in your mid-30s, you're not going to touch your super for 3 decades, I would say if you're not comfortable with volatility, best to get comfortable with it or stop looking at your super balance. But putting aside, the risk profile or risk appetite considerations, just looking at the pure financial fundamentals, go all growth, all share market. If you put all your investments all in the share market, look at the statistics over the next 30 years, that approach is what's going to deliver the highest returns for you. Just a question though, or just another observation with respect to Hostplus's index balance or index growth options. They are all traditional market cap indexing, which means they've done pretty well over the last couple of years because the market's really been driven by large cap stocks, both here in Australia and also internationally, particularly in the US. And, whether that's going to continue or not, well, I mean, nothing continues forever, right? So that's a positive for the last few years, but it's also a negative in terms of the risk in the portfolio. So that's something you need to really think carefully about. I would think that actually just going in Hostplus's or even UniSuper, for example, as an alternative industry fund, high growth option or full growth option, just their normal, not indexed. I know it's a little bit more expensive, but at least it allows them as the fund manager to accommodate some of the risks that are intrinsic in the market at the moment. And I actually think that's probably a better approach than going index balance, but just a bit of a side comment there. Okay, the next question I have is from Josh, but it's a bit of a long one, so I might leave that one to tomorrow, and I look forward to talking then. Cheers. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.